We're back on Morning Movers. We're watching shares of Apple after Jefferies upgraded the stock to a hold from underperform. The analyst believes the company will be exempted by U.S. tariffs or from U.S. tariffs, but the risk of a global recession could further impact already weak iPhone demand. Shares choppy in the pre-market. Time now for Options Corner. Joining us to take a deeper look at Apple, we've got the Duke of Data himself, Rick Ducat, lead market technician for Schwab. All right, talk to us about the trends that you are seeing when it comes to the chart for Apple, Rick.
Yes, a very difficult few sessions here for Apple here. And if we start out by looking at our comparison chart, we're looking at a comparison change over the past year from Apple and its sector, the XLK and S&P 500. You can see that although Apple has held up better for the most part and is still positive during the past 52 weeks, unlike its two other components of this chart here, it's been a very steep drop off here. So not looking good recently here. So when we look at Apple more specifically, we can see when we look at our 1 year chart, we have now filled a gap that was from all the way back on the earnings from May 2nd of last year here, that green line on our chart near about 173. You can see that now as of yesterday's close, we have filled that gap from almost a year ago here. So this becomes now a key supportive area. And it looks like perhaps maybe we're not going to hold below it, or hold above it rather here. That it looks like we're poised to open a bit lower here. So for now, if we were to try to recover and move to the upside, the gap level, the post gap up lows come in around 196 or so, or excuse me, 180. And then we have 196 is our next low point there, that pink line. Look at RSI as well, our measure of momentum, moving lower, moving into the oversold territory on heavy volume. You can see all the volume spikes there that we've seen during the past few sessions. Now, if we were to look at our next chart with volume profile and standard deviation channels, we can see that the next volume node here is about where we hit our lows yesterday, near about 170. So this is extra emphasis on this area that we had our gap in. Notice as well that we have fallen below our -3 standard deviation channel, our red line there, 3 standard deviations below our linear regression line. So certainly a difficult few sessions here, a difficult setup here as we approach the middle of this trading week here, Diane.
All right, difficult setup, certainly. Definitely seems like that's the case, especially when you think about the tech trade as it relates to tariffs. Thanks, Rick. Time now to go through an example trade. For that, we've got Tom White, senior options contributor, co-host of Fast Market. All right, Tom, how would you go about an example trade for Apple, especially in the context of kind of this broader market volatility that we're seeing?
Yeah, volatility levels near 3-year highs here in Apple. That gives you some opportunities. I think a lot of people are looking at Apple going, well, how do I buy this stock even though there's a lot of tariff risk to this company? It's down over 33% from its all-time highs that we saw just a few months ago. So this strategy using the option market leverages that high implied volatility, gives you some cushion to the downside, and gives you maybe an entry point for the stock if it does continue to fall. So I looked at an unbalanced put butterfly here to the downside where I'm actually going to buy it and collect a credit. So that's going to lower our break even on this one. So going out to the April 25th weekly cycle, that's 16 days to expiration. You're going to avoid earnings, which comes May 1st. You want to avoid that event risk on this one, where I'm going to buy one of the 160 strike puts, sell 2 of the 155 strike puts. So it's a back ratio that you're buying, where it's a 1-by-2 ratio put spread. Now, buying one of the 160 puts, selling 2 of the 155 puts, you're going to actually collect a credit of just over $4 on this if the stock opens up around that 170 level, which is where it's at right now. By collecting that credit of $4.20, it's going to take my break even on this one down all the way down to $145.80 to the downside. That's about 14% below the current share price. But because I'm buying 1 and selling 2, I've got a short naked put there, right? That allows me, if the stock does continue to fall below 155, to buy the shares if I'm still short 2 of those puts, to buy the shares at that break even of 145.80. So you'd be buying the shares at a really steep discount. Now, if it doesn't continue to move lower and it just stays where it is, maybe goes a little bit lower, you get to keep that credit that you collected, $420 per spread that you do on this one, with a little bit of a kicker. at or near that 155 strike. So that gives you that little bit of bonus if the stock does continue to move down. But this might be one of those strategies that you can take advantage of high implied volatility. You're scratching your head saying, where can I get in? What's a good entry point for Apple with all this uncertainty in the overall market? Well, this type of strategy takes advantage of it. You're avoiding that earnings event, but it gives you that nice big cushion of about 14% before you start getting hurt on this trade, with the added benefit of that little kicker at or near that short 155 strike where you sold 2 options.
Got it. All right. With this example trade on Apple, once again, you are avoiding earnings on May 1st. Thanks a ton, Tom, for that example trade. Shares of Apple fluctuating in the pre-market right now, a little bit higher off the back of this upgrade, though had been lower. Broad market action, though, weakening. The S&P 500 once again flirting with bear market territory as the tariff situation escalates between the U.S. and China.